Most investors are completely wrong about where the market is headed. Today, I'm going to show you the new game plan from Steve Eisenman, the man famous for predicting the 2008 crash. And I'll give you a simple map to the entire stock market, the 11 sectors, so you can spot these opportunities yourself. Eisenman says the big story isn't what you see on the news. He's looking past the obvious names and focusing on a forgotten part of the tech industry that AI is about to make explode. Stick around because this is the kind of insight that gives you an edge. The market is hitting all-time highs. We see massive AI deals like the one between AMD and OpenAI sending stocks soaring. At the same time, there's political chaos in France and a new pro-business leader in Japan. It's a lot to process. But Eisenman's message is clear. Stop worrying about interest rate cuts. He believes the Fed might cut rates by 1% at most. With inflation around 2.5%, rates can't go back to zero. The current economic situation is stable. It's a bull market, and many are betting on the wrong horse. He says the real money isn't in guessing the Fed, it's in identifying the companies that are winning right now. And the biggest winner is artificial intelligence, but not just the names you already know. To understand where to look, you first need to understand the map of the market. The stock market is divided into 11 sectors. Knowing them is more than what the average investor knows, and it's your key to making better decisions. Let's do a quick tour. First, there's technology, the XLK ETF. This is the star of the show, with giants like Microsoft, Apple, and Nvidia. It's been the top performer for the last 10 and 20 years. Next, my personal favorite, consumer discretionary, the XLY ETF. These are things we want but don't need, like Amazon, Tesla, and McDonald's. It's another long-term powerhouse. Then you have healthcare, XLV. It's had a tough year, but companies like United Healthcare are starting to recover. This sector could hold future opportunities. For more conservative investors, there's consumer staples, the XLP. These are companies we always need, like Pepsi and Constellation Brands. They are what I call inevitable stocks. We also have financials, XLF, with banks and insurers, industrials, XLI, like Caterpillar, energy, Energy XLE, and real estate, which is interesting for dividend seekers, and newer sectors like communication services, with Meta and Google. Investing in these is simple. You can buy an ETF like the XLK for technology through any regulated broker, even with fractional shares. If this breakdown is helping you see the market more clearly, do me a favor and hit the subscribe button. It's free and it ensures you won't miss these updates. Now, let's connect this back to Steve Eisenman's big idea. He says the AI revolution is just getting started, but the most interesting part isn't the software, it's the hardware. AI is creating an energy deficit. It needs massive data centers, servers, and electricity. But even more, it needs to store unbelievable amounts of data. This is where the forgotten companies come in. Think about hard drive manufacturers like Western Digital and Seagate. For years, everyone said hard drives were dead. But AI models need to be stored somewhere, and these companies are the ones making the storage. Eisenman believes their earnings could triple, and analysts are way behind. It's the same story for memory chips from companies like Micron. AI needs incredibly fast memory for what's called inference. These companies are in an oligopoly, a market controlled by just a few players. When demand surges, prices and profits surge with them. This is the picks and shovels play. During a gold rush, the surest money was made by selling picks and shovels to the miners. Right now, AI is the gold rush, and companies providing the essential hardware are the new sellers of picks and shovels. Another sector Eisenman is bullish on is insurance, specifically companies like Universal Insurance Holdings. Higher interest rates are great for them because they earn more on their float, the premiums they hold before paying claims. In places like Florida, competition has disappeared, allowing well-run companies to thrive. This is a business with a predictable model, trading at a very low valuation. This is exactly the kind of thinking we should apply. Look where others aren't. While the world is watching Nvidia, the smart money is looking at the entire supply chain. That AMD OpenAI deal isn't just good for AMD. It's a signal that the demand for AI infrastructure is exploding. Even in places with bad news, there can be opportunity. The political instability in France has made French stocks cheaper. It might be a good time to go fishing where others are scared. Speaking of individual stocks, here are a few on my radar. Constellation Brands, the beer company, is reporting soon. People don't stop drinking beer in a recession. It's an inevitable business. The same goes for Pepsi. On the other hand, you have companies like Aston Martin. It's a luxury brand, but the business is capital intensive and just issued a profit warning. A great product doesn't always make a great stock. You have to focus on the financials. Remember, the key is a long-term perspective. Don't get shaken out by daily news. Focus on identifying solid companies in growing sectors and understand that private investors like us have an advantage. We can find these unique stories before the big institutions do. So, my final advice is this: build a diversified portfolio. Understand the 11 sectors and look for the inevitable companies and the picks and shovels plays that will power the trends of the future. Which of these 11 sectors are you most excited about right now? Let me know in the comments below. And if you haven't already, make sure to subscribe for more insights.